Here's why the Federal Reserve should cut interest rates and much more at its meeting next month. Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. The Federal Reserve Open Market Committee meets again in about 3 weeks, and the focus will be on whether the central bank cuts its base interest rate or holds steady. The consensus is that the Fed will sit still. It shouldn't. Instead, the rate should be reduced, but not for the reasoning that dominates Fed thinking. For years, the Federal Reserve and other central banks have operated on the assumption that an active economy causes inflation. The Phillips curve is an economic model that posits that there's a trade-off between inflation and unemployment. If you want lower inflation, you must increase unemployment and vice versa. Experience shows the Phillips curve to be nonsense, including recent times. Unemployment remains low, yet inflation has fallen down from its peak in 2022. Nonetheless, the Phillips curve has a vice-like grip on central bank thinking. That's why many commentators believe the Fed won't move. The economy is growing, and there's still signs that inflation hasn't been totally beaten down. Thus, in their way of thinking, any reduction would be premature and run the risk of rekindling inflation. In addition to being wrong, basing policy on Phillips curve thinking ends up depressing private investment, thereby hurting long-term growth. Short-term interest rates today are too high. They're above longer-term yields, a sure sign of a credit market distortion. They are hurting businesses, especially smaller ones, to access credit. By contrast, big companies have no problem selling bonds or getting short-term cash from banks or peddling commercial paper. Also hurting small enterprises are Fed regulations concerning banks setting aside reserves for different kinds of loans. This currently damages availability of credit for non-big enterprises. That is a key reason why the bank category called commercial industrial loans, which go principally to non-large entities, showed a shocking decline last year. Economic growth is fueled now by consumer and government spending, an unhealthy mix. Putting on even more capital requirements, as the Fed may do, will dampen bank lending. The Fed must grasp the truth that inflation is caused by reducing the value of the dollar, not people buying and selling with each other. Rising prices are a symptom of inflation, not its cause. So the Fed should cut rates and announce that henceforth its focus will be on a stable dollar. At the same time, Fed head Jerome Powell should announce that the central bank will work faster to reduce the size of its bloated portfolio of bonds, as well as continuing its wind down of reverse repurchase agreements, whereby the Fed was borrowing mammoth amounts from money market funds and financial institutions. Declaring that dollar stability will be the Fed's focus will create a very helpful environment for commercial investments. The harmful focus on manipulating interest rates would be over, and the economy would benefit enormously. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.